Hey guys, happy 4th of July. It's our off week. We're vacationing this week at Stacking Deeds, so we're going to replay one of our favorite episodes.
So sit back and listen to episode number 6 with Jasmine Krnjetin. She's going to talk all about financing your first deal, and we will be back with our regularly scheduled programming next week.
Happy 4th of July.
Happy 4th of July.
Live from the back of Ruth the Realtor's stretched-out car, it's the Stacking Deeds Show. I'm Ruth's part-time mechanic, neighbor Doug, and we have a show for all you homebodies today. Well, that's because we're talking homes to somebody out there. Come on, it was a good one. Here's a question. How do you finance your real estate empire? Here today to talk money, we welcome mortgage pro Jasmine Krnjetin. In our headline segment, let's talk vacations and timeshares. Should you invest in a timeshare to make loads of money? We may have thoughts. Plus, today's Ring Ruth's Rotary hotline caller just might have a real estate strategy that will give you the chills. And then, as icing on this cake, I'll share some primo top shelf trivia during our property pop quiz. And now, 3 hosts who don't need to be reminded to buckle up or to collect rent checks. It's Crystal Hammond, Alan Corey, and Joe Saul Seahigh.
Welcome to Stacking Deeds. I'm Alan Corey at Real Estate Maxi. Sitting back with me in the seat here, 2 of my favorite people, Crystal Hammond at Condo Crystal and Joe Sal Seahigh at Average Joe Bunny. It was good to see you guys again.
Good to see you too. We're so close. Like, we're your favorites. That's because we spend so much time together.
Aren't you glad everybody showers?
Yeah, I was
Yes.
afraid to say anything different just because we are in an enclosed space here, but it's feeling like home at this point.
We're running a tightly oiled ship, even though the car is the size of a ship.
We say just moderately tight, Crystal. Moderately.
Medium.
Kind of well oiled. Right.
3 adults in a size medium back seat.
So today we go into financing, huh, guys?
Yes, we will talk money with Jasmine Krnjetin.
Super fun. But before that, we got a headline. So why don't we, let's check out the radio.
Hello, chaps. And now our Stacking Deeds headlines. Cheerio and pip pip.
Our headline today comes to us from John Oliver. And Alan, you brought this one to the table. John has a little beef with a portion of the real estate industry. Well, let's just listen in.
With it being spring break season, our main story tonight concerns vacations. A wonderful time to realise that you're in love with someone or realise that you are absolutely not. And be honest, you knew in the TSA line before the flight. Keep the streaming passwords for as long as you can, but do give back his grandmother's ring. Specifically, we're going to talk about timeshares. And some of you might be thinking, hold on, are you going to tell me that they are a scam? Because surely everybody knows that. And it is true that the sketchiness of timeshare vacations has been a punchline on TV for years.
You moron, these aren't free vacations. These are time-sharing deals. They're total scams.
These timeshare people, they don't stop until they sell you something. They prey on the weak and gullible, i.e. you.
Perhaps you and your yellow friend would like to set up a timeshare plan.
Don't do it, Sandy! I won't give in to your timeshare vacation scam!
Yeah, suspicions about timeshare programs are so ubiquitous they can get laughs in children's programming. And look, obviously, SpongeBob was never going to say yes to a timeshare, otherwise they'd have had to change his theme song to this.
Oh! Who lives in a pineapple under the sea, except for 1 week a year when he's in a studio in Key West.
I don't want to see him change a SpongeBob song, so clearly he can't buy the timeshare. But, Alan, there's a reason you brought this up. Obviously, a lot of people think timeshares are a scam. So you weren't playing Mr. Obvious here, were you? Timeshares are actually a scam?
There's one thing that I want to separate from real estate investing is timeshares. So I hate that I have to give this disclaimer quite often. It's not real estate investing, and I don't even really think it's real estate. You don't own a title or a deed to anything. It just gets grouped in, and I think it's very important to talk about.
I agree. I have been invited to a quote-unquote dinner by a not-so-bright friend that's like, hey, come to this free dinner. I'm like, yes, free dinner. Yes, I'll show up every time for free dinner. And then They're taking a long time to bring the food. Then there's an easel, and then you see the screen drop down, and you're like, oh no, it's the point of no return.
Oh
it's
no,
a
there's
timeshare.
There's no such thing as a free dinner, it turns out.
Right. So he's like, oh, it's my chance to dabble in real estate. And we're like, this is not real estate. You are now using the same lingo to us that hooked you in. And now I'm thinking back, we never even got invited to go enjoy this timeshare after our friends sucked us into this fake dinner.
He ended up buying it?
Yes.
He bought one and didn't even get to go. He drags you.
It's like, give us the number of 10 of your friends that you can invite for dinner.
Was he getting some kind of a referral bonus for bringing you along?
If one of us were convinced, I'm not going to say gullible or dumb enough, inclined.
I had a similar thing. I was the dumb friend, Crystal. We were checking into this huge, beautiful Wyndham Resort in Orlando when I was running this marathon. This woman goes, so you have any plans while you're in town? I'm like, yeah, I'm running at Disney. She's like, oh, you going to go to the parks? I said, well, in fact, we are. And she goes, you need to talk to that guy over there at this other desk because he's got these discount tickets that we give to people. I'm like, that is cool. This is the coolest thing ever. So I walk over. I'm like, yeah, I'm interested in discount tickets to the Disney parks. He's like, awesome. I got you hooked up. So here's what happens. We just put you in a golf cart and we take you around and show you this resort. I'm like, oh, that's a neat perk. That's pretty
lucky
wild.
Day.
What's funny is Cheryl, my spouse, and this other couple we're with are standing off to the side, and I look over at them. I'm like, you guys got to come over and hear this. This is awesome. And Cheryl's like pointing to her watch like, we got to go. I'm like, whoa, whoa, whoa. I'm scoring us a big deal. You can't go yet. Then we go into a meeting, and he then talks about it more. And all of a sudden, I don't know what it was, Alan, I go, holy crap, this is a timeshare presentation. Then I said to him, well, what if I can't stay for the whole meeting? Like, can we still get the tickets? He's like, oh, no, you got to stay for the whole meeting. I'm like, yeah, but, we're going to be kind of pressed for time. He's like, oh, and all of a sudden he realizes he can feel me backing away. And then I can see the claws come up and he starts going into objection handling. I was in sales.
They're so aggressive.
Oh, you can totally feel it when they go into objection mode. And he's like, well, you don't want the free Disney tickets? I'm like, well, yeah, I do, but I don't want to waste an entire day on something where I just tell you no later. My sister-in-law and brother-in-law, by the way, took an all-expense-paid trip to Hawaii.
Ooh.
And they made it this Hawaiian vacation. And they said, listen, all I got to do is spend half a day in a timeshare presentation. We get the other days for free. So they did it, which felt kind of dirty to me, too, on the other side.
That's why I don't like timeshares as well, because imagine if you ever want to sell yours, you're competing with this whole team and this whole system and golf carts and airplane tickets and Disney tickets. You can't compete with that as a for sale by owner sort of person. That's the other rub, and what John Oliver gets into. It's pretty impossible to sell and get rid of. Mm-hmm. I went on eBay just now, and there's thousands of them that are for sale for $1. It's just people trying to get rid of them, and you can't because you're paying HOA fees, and it's just this lifetime of fees and debt that you can never pay off. It's unfortunate, and a lot of people feel a lot of shame that they fell for this trick. Then you can't get out of it because the people who help you get out of it are also sharks, and it's just this never-ending spiral.
John Oliver goes into that. Let's listen to what John says about the people getting you out of timeshares. This is a story about a woman who hired one of these firms. Well, listen in.
Denver 7's actual news team had this story to report.
Debbie hired the company in June 2019. In all, she paid more than $14,000.
Signed a contract, a 2-year contract, that ended this last June. Well, under the terms of the contract, if they don't resolve my issue, I can get a refund.
2 years came and went. That's when she went looking for answers.
And so I came to see them, and it's empty.
The signs are still up on this office in Greenwood Village. But there's no employees. The furniture is gone.
Wow. First, I'm not sure it was totally necessary to force her to go back and knock on the glass of a clearly empty office, but I'm very glad that they did.
Debbie.
The news team's like, speaking of Mr. Obvious, news team, hey, can you go knock on the window? Well, you can see it's empty. There's nobody there.
They go after the low-hanging fruit. This goes back to the Nigerian scamsters. They leave typos in the emails because they want to filter out people that can catch on to red flags. These companies target people that have a timeshare, so they're like, oh, this is is our target audience. People that said yes to a timeshare, they're definitely going to say yes to someone that can help them exit. And then boom, they're scammed again.
The way these things are written up, if you pass away, your heirs inherit the debt, and they have to write a letter within 9 weeks to the government saying you want to pass on this debt, and then the next sibling in line and their kids. It's a racket. It's a process. Unfortunately, I don't have good answers. There's no good answers out there except hire your own personal lawyer that can help you out or do the research yourself. But a lot of these exit timeshare sort of companies are not worth $1.
Or the advice is don't get one in the first place. Or they're like boats. You don't want a boat. You want a friend with a boat? Is that
Get a friend with a timeshare.
Yes.
the mentality?
I got to tell you, I've enjoyed a couple timeshare places that friends have had.
Me too. Same.
It's their
Great
thing,
time.
not mine. But to your point, Alan, about some of the fees and the secondary market, I know that Disney's timeshare system, if you buy it directly from Disney, you get a whole different set of perks than if you buy it on the secondary market. Going in and trying to scoop one of these things up for $1, you're not even getting the same thing that you would get if you bought it directly from the staff. And I know, Alan, that you would never buy a timeshare in a million years.
I won't buy anything with an HOA. I want to be 100% control of my property. I don't want anyone else giving me rules of what I can plant, what I can't, who I can rent it to. I have no control over anything. I can't make moves. I can't make money out of it.
I think that's a good place to leave this. Crystal, great advice. The best way to get out of this is don't start.
Don't do it.
All right, guys, I'm getting out of the car.
Always great to hang out with you, Joe, and always great to get extra leg room.
Have a great rest of the show.
Later, Joe.
Alan and I are curious about your timeshare experiences. Are they good, bad, happy, sad? Tell us about the fees. Tell us about the fun. We want to hear it. Go to stackingdeeds.net/voicemail. You may hear it on a future episode.
Coming right up, we have Jasmine Krnjetin from Jasmine Mortgage Team. She is my personal mortgage lender. I've probably done 15 to 20 deals with her. I send all my clients there because she breaks it down so easy for you, and she'll do a free phone call and consultation to just say, what are your goals? Let me help you get there, because a mortgage lender is going to be your probably biggest partner in creating wealth. Make sure you find a good one. But first, we've got a property pop quiz from our buddy Doug.
Hey there, Deeters. I'm Ruth's Fetch It Boy and part-time mechanic, neighbor Doug. And it's your favorite part of today's show. That's right, your property pop quiz. Today, you are gonna have to earn your stripes. According to Zillow data compiled by thezebra.com. Get it? See, I said stripes, and then the site was the Zebra. Fine, I'll just do the quiz. I thought they needed a little bit of help. Anyway, okay. The average home price in the United States in 2022 was $348,000. Did you know the least expensive state to buy a house in was West Virginia, with an average sale price of just $127,000? But here's today's question. Which U.S. state was the most expensive? West Virginia, take me home. I'll be back right after I go find a mountaineer. It's like a reindeer made of rocks or something, right? Come on, I don't even get a rim shot for that, Nugget.
Are you tired of making money the old-fashioned way? Do you want to join the ranks of successful real estate moguls and live like a Kardashian? Well, grab your oversized sunglasses and get ready for the Real Estate Investing for Beginners show. Our hosts may not have any formal training, but they've watched enough HGTV to know what's up. They'll teach you how to spot a fixer-upper from a mile away and flip it faster than a pancake on a hot griddle. Don't be a basic 9-to-5er. Subscribe to the Real Estate Investing for Beginners show today and start living your best life, or at least pretending to, on Instagram.
Aloha, Deeters and warm weather lovers. I'm Ruth's mechanic, neighbor Doug. In 2022, according to Zillow data compiled by thezebra.com, the average home price last year was $348,000 across these United States. But my question was, what state feels like every resident hit the lottery? Well, let me lay it on you so you can start to hula over to the nearest mortgage broker. The priciest state? That's right, with an average price of $959,000, the most expensive state to buy a home was Hawaii. Hi, Moana! There must be some good money in luau's or volcanoes or sea turtles or something. That's it! I'm going to start a lava-themed luau resort with all-you-can-eat sea turtles. I'm going to be the biggest Hanu hero. Heck, I'll sell Hanu hero sandwiches. Oh, it's like this marketing genius stuff just coming at me all at once. I amaze myself. While I go plan my great new side gig, why don't you sit back and say hello to mortgage guru Jasmine Krnjetin.
So today I have with me Miss Jasmine, and I will not butcher your name.
You're not even going to try a little bit?
Yes, okay. Krnjetin.
Almost. Krnjetin. I also go by Mortgage Queen, so...
Okay, so Mortgage Queen, what got you into the exciting land of mortgages?
It actually is pretty exciting. I love helping people make smart financial decisions. I've been doing it for a couple decades now, and initially it was... I was good at math and I was a good salesperson, so it seemed like a natural fit. I got into it not really knowing what big impact doing mortgages actually has on people's wealth and life choices and well-being. But now looking back over the last couple decades, I really feel like I'm very, very lucky to be in a career where I can actually make an impact on people's lives.
Purchasing a home, that's the biggest purchase. Like, that's a huge six-figure, at least for most people, number.
Oh, yeah.
When I'm looking online, I'll see the rates are here, but what are the gotchas? Sometimes those rates seem to be too good to be true, and then when you finally get to the approval, the rate is so much more than what was quoted online. Is this for someone with a perfect credit score online, or is this because you paid fees? What do those numbers really mean?
There is so much to unfold when somebody chooses to buy a home. It's got to do with all the emotions that we attach to feeling at home. It's got to do with security. It's got to do with money. Most people would rather talk about sex than talk about money, right? Because they're like, you ask somebody how much money they make and they're like, oh my God, I don't know.
None of your business.
Yeah, exactly. There is so much that goes into buying a home and getting a mortgage, yet the words that come out of people's mouth are always, what's your rate?
Right. Number one, like one of the pickup lines. So what do you do?
Exactly. What's your rate? It's not easy figuring out what the final interest rate is. There is a lot that goes into it. In a way, when you find like those oversimplifications online where it's like, oh, everybody else has a 6% rate, but this bank is advertising a 4% rate. It's like, okay, we all get our money from the same place. Fannie Mae, Freddie Mac, our mommy and daddy of all mortgages in the country. We're all selling the same product. How different can it be? Maybe it's an eighth of a difference. Maybe it's a quarter, but it's not going to be 4% versus 6%. And if it is, then like you said, what's the catch? Are they pricing it out online with the perfect credit score and 25, 30% down and the perfect debt to income ratio and a 10-day lock and a 15-year rate or an adjustable rate, or what are they doing, right? And then ultimately it comes down to like, how much money are you going to spend on the rate? Like, yeah, if you wanted to lock a 4% rate today, I could probably do that for you, but maybe it'll cost like $37,000 freaking dollars to just buy that rate. Like, I mean, do you really want the 4% rate? I don't think so. I think what you want is a good rate, something that's going to make that monthly payment comfortable and that's going to give you a comfortable cash to close, because ultimately when you move into a home, you don't want to be broke. You don't want to have spent all your money buying like the perfect rate and then you don't have money for an alarm system or whatever you need to move into a home. I'm a big believer in keeping cash aside, not spending every penny you have to get into a home, just because there is so many expenses, so many things that you need after you put that down payment, after you get the keys. That's when everything costs so much money, from moving to just, you're going to need a new couch. Something is going to go wrong. You're going to want to replace the water heater, all that kind of stuff. To come back around to your rate question, there is a lot of gimmicky things online. You should always work with a trusted mortgage advisor who can present you with all the different rate options. If it sounds too good to be true, it probably is. Ultimately, if you end up working with some sort of a super duper discount broker that is going to have a slightly lower rate than everybody else, my experience has been that you get what you pay for in the mortgage space, which means that if you are working with a discount broker type of situation, you're going to get get very little hand holding. You're going to not receive the type of service that you want to receive when you are buying the biggest purchase of your life to date, potentially. You really want to have a person, somebody that is actually in charge of your file, somebody that's going to be there for you, not just to fast talk you into getting the mortgage on day one, but like somebody that's going to be there to hold your hand throughout the whole process and still be there closing day to deliver what they promised.
I'm glad you brought that up because that's what a lot of people wonder too. I've wondered myself. When I'm looking online rate shopping, you'll see the places like, your Rocket Mortgages and places like that. Mm-hmm. And a lot of times they have that lower rate. Let's unpack some of the other factors that go into the interest rate that you pay. I think you mentioned credit score.
Yes. So credit score is probably one of the biggest factors, at least with conventional or jumbo mortgages. The rates are very, very credit score driven. So the better your score, the better your interest rate, up to a point. There isn't much of a difference between if you have like a 760 credit score or an 805 credit score. At that point, it's all top tier. But there can be a big difference in the mortgage interest rate between like a 660 credit score and a 720 credit score. And then also mortgage insurance is another piece of the puzzle, periphery, if you will, but it does impact your monthly mortgage payment if you're not putting 20% down. And that is also very credit score driven. So it does behoove you to maximize your credit scores before you start going and starting to look for a home. And typically the way you want to increase your credit scores are just take a look at your loan balances, pay everything down to about 30% of the limit. If you don't have enough trade lines, maybe add an authorized user account or two or credit card on your credit so that you have more trade lines. There's little things that you can do a month or two in advance to just scooch that up. If it's a 680, maybe you bump it over a 700. So yeah, credit scores are number one. Loan to value, how much money you're putting down, that has an impact on your interest rate. Debt to income ratio, especially now there have been some newer changes that may be still unfolding with conventional loans. If you have a 45% debt to income ratio, maybe your interest rate is more than if you have a 40% debt to income ratio. So debt to income ratios also impact it. Those are some of the main drivers to the interest rates.
What is a perfect debt to income ratio? Number one, and then we'll also go over these two for what we're putting down. If I am buying my first home versus if I'm buying my first investment property.
For a first-time home buyer, it's 3% down is good enough. You can get a pretty nice loan with a 3% down payment. Some of us have 100% loans as well for first-time home buyers. I don't use those. If my buyers do have a 3% down payment, you will always get a better rate if you do 3% versus if you do a 100% loan, in my experience. So I would suggest probably doing 3% down if you can. And then for an investor, like you can get a loan as an investor with as little as 15% down. But you're going to have mortgage insurance and that interest rate is not going to be super pretty. And then 20% down is kind of like the standard. And then for all of my overachievers out there, 25% will get you the best interest rate as an investor.
Oh, I did not know
So,
that.
it's like pick your own adventure.
That's very helpful. That's very informative. What kind of loan products are typical for first-time investors?
First-time investors, most of the time, for the first handful of investment mortgages that you get, I would say you should just stick with the regular 30-year fixed. Don't do anything fancy. Just get a 30-year fixed conventional mortgage for the first 4 or 5 properties if you can. Once you start having more than conventional guidelines will allowed, then you need to start getting a little more creative with some portfolio loans or debt service coverage loans or bank statement loans or all that kind of stuff. But first handful of investment properties, I would just go straight up Fannie Mae, Freddie Mac, 30-year fixed with whatever you can afford. If you can do 20% down, great. If you need to conserve the down payment and you want to just start with a 15% down payment for the first one or the second one until you have enough cash, I would rather do a 15% down loan and get a property now than wait to have 25% down and lose a year and then invest, because you're going to lose that time and you can always refinance and get out of the mortgage if the rates improve, if you have more equity, all that good stuff.
What if, I've been in my primary home for about 3-4 years. What about tapping into my equity? How would I even go about that? Would I come to the mortgage queen and say, hey, I've been in this house and I'm ready to buy an investment property?
Yeah, so we would just take a look at how much equity do you have available in your home. So let's say it's worth $100,000 right now and you have a $50,000 mortgage. Most home equity loans will go to a max of 90% loan to value. So in this case, that would be the total you could borrow would be $90,000. Out of that, you already owe $50,000 on your first. So that would allow you to tap into about $40,000 worth of equity for your home equity line of credit. And then you would have a home equity line of credit on your primary for $40,000. We would use that money as a down payment for your next home. So that would be like your 20% down payment on a $200,000 investment property that you're looking to buy.
Got it. Based on my equity, I could go shopping with that as a 20 or 25% down payment.
Yeah.
And then
you
that
would
way,
just kind of see what makes the most sense. And then when it comes time to lock in the interest rate, we could take a look at what does a 15% down feel like versus a 20 versus a 25. And then we would just kind of decide. But of course, if you only have $40,000, you would maybe want to try and maximize that and try and get a couple properties or a couple doors with that money, because that's going to be kind of like your investment fund, your seed money, if you will,
right?
to start the adventure. But or alternatively, you could say, well, I am going to tap into the equity and then I'm going to buy my new primary residence. So you would rent out the home that you're in. You would pull out the equity first, rent out that home, and then buy your new primary residence with a 5% down payment. The trouble there is, of course, you have to move into your new primary residence. But if you're just looking to expand your portfolio and you're flexible on where you live, then you could use that for a 5% down payment on the next primary home.
Oh,
I know people that move like every year or two. They just buy another, rent. I mean, that's what I've done. Even though I'm in a mortgage business, I never really set out to have $5 million worth of real estate, but it just kind of happened because it's like, well, I bought this one and then I held on to it. And then I bought that one and then I held on to it. And then my mom bought that one and we held on to it. And next thing you know, it just happens. So if you give it 20 years, you just kind of have to make a move once or twice every year or two. And next thing you know, you kind of end up and it's like, well, I guess I have some money invested in real estate now. So
you have your own monopoly block.
Yeah, exactly. You just kind of like you play your little game and you just move your pieces around. It's also like a really easy way for people to sort of start building generational wealth with all the information online. There's like the Grant Cardones of the world. And it's like, oh, I bought these 800 doors and I bought 1 million doors here. And like, you know, like, and you just kind of feel like, oh my God, I don't even know. But if somebody tells you like, well, if you're flexible enough, every couple years, you could buy another home and you do that for 20 years straight, you're going to be okay. You're probably going to end up with 10 properties.
Oh, definitely. So that's another question. How many mortgages is too many mortgages? So let's say I come to you and I'm on my 5th house and I'm like, okay, time to buy a new place. Are you going to say, okay, Crystal, you might be over leveraged here or?
So technically the most on a conventional side of things, you can't have more than 10 properties financed.
Okay.
That's with a conventional to get a conventional mortgage. So if you were trying to buy your 10th conventional property. But most people will start using like debt service DSCR loans or other types of investment vehicles once you get to that point where you have a bunch of them. After 10, you got to start thinking about. When I'm talking to my clients, I'll typically guide them in the direction of like, if we have a husband and wife, instead of, okay, maybe the primary residence, we have both of them on the mortgage because we need both of their incomes. But then once we have the ability to sort of divide and conquer, maybe she has 10 mortgages and he has 10 mortgages and they don't need to be on the mortgages at the same time, then you can kind of stretch from a 10 max to a 20 max. If it's you and a partner or whoever, you don't necessarily, you can be on title, right? You can legally own the properties together, but you don't have to, you don't necessarily all have to be on the mortgage, especially like sometimes, you know, you'll have like 4 people go in and they're like, okay, we've got this little investment fund and we're going to buy all these properties together. I always kind of stop them. I'm like, okay, I don't need all 4 of y'all on my loan application. Let's just do one of you at a time and everybody else can be on title. That's a way to keep going with conventional mortgages because those are typically the cheapest. Once you start getting into the more the commercial side of things, or if you're buying an apartment complex with 5 doors, 10 doors, all that kind of stuff, that's a whole different ballgame, but that's also commercial financing and that's more expensive. It needs a bigger down payment. The loan terms are typically shorter. You may or may not have balloon payments. payments versus conventional mortgages are just like nice, neat, organized. You've got this rate for 30 years. See ya.
Got it. No
Those are really good.
surprises. What shall I be looking for when I'm shopping for mortgage lenders?
So mortgage lenders are similar to real estate agents. Personality, fit, and how you mesh with a team that you're going to be working with is really important. You want to look for somebody that's going to be available to you, that's not going to make you feel like you're foolish for asking too many questions. Most real estate stuff does happen like late in the evenings, right? Because that's when people are not working, or in the weekends. Is the person that you're working with just working bankers hours, 8 to 5, 9 to 5, or are they actually going to be available when there's a multiple offer situation going on at 7 p.m. on a Sunday? Are they respected, and do they come highly recommended in the community? You will find like the good lenders will typically get recommended over and over again. Also, a lot of times real estate agents will refer you to a lender to work with, and that's always a really good starting place because there is no kickbacks from real estate agents to lenders or referral fees or anything like that. The only reason a real estate agent recommends a lender to you is because they know this person can get you to the closing table in one piece, right? They've done transactions with them. They're not going to leave you hanging at the altar, right? So it's good to work with somebody that comes highly recommended. Do they get good reviews from the first-time home buyers? Do they work with a lot of investors? You'll get a feel for people through online reviews. If they don't have much of an online presence, then,
Right. Red flag, red flag.
Those are some of the most important things to look for. Do they offer upfront underwriting? Are they going to get you underwritten before you go under contract? How quickly can they close? If they're like, oh, we're averaging 45 to 60 day closings, maybe they don't have a really good process in place. So how quickly can they close? How transparent are they with the information that they're offering you? Are they playing like the whole wizard behind a curtain, and it's like, oh, what's my rate? And they give you a number. They don't explain like, these are all the rates that are available to you. These are all the different loan options that are available to you. Are they just going to hand you a rate sheet and say, here, this is your rate, sign? So I think it's just important that you work with somebody that really gets you. For me, I do a lot of video calls with my clients because I feel that that's nearly as good as meeting in person. We get a really good connection that way.
I do remember working with a mortgage broker, and he was like, well, here, I'm going to tell you what my fee, like, this is how much I make if you put 10% down versus 15% down versus 20% down. I thought that was out of the norm. I like that is an option where you can ask, hey, how much is in it for you? And that transparency brings another level of trust.
I agree with you on that. I think it's important that you understand what the different levers are that you can play with so that you can kind of customize the loan program to make sure that it meets your requirements. Sometimes I'll have people like, I'm going to keel over if my monthly payment is over $2,000 a month. And then you're like, okay, we got to do whatever we got to do to get you to $2,000 a month. Before you start talking, like one of the first questions I ask my clients is, have you looked at your monthly budget? What's a comfortable monthly payment? That's my guiding light. If they say $1,700 a month, and then the next thing they say, we're looking at $550,000 homes, I'm going to be like, okay, time out. There's a disconnect here, my friend.
Right.
Because yes, I may be able to approve you for a $550,000 home because you make enough money and maybe you don't have a lot of debt. So technically you can afford a $500,000 or $700,000 home, but you just told me you don't want to spend more. So I will typically work the way I do my pre-approvals. It's going to be like, you can go up to, but I'm going to give you a pre-approval letter for $250,000, right? Because that's what you said you wanted to spend every month. So as a consumer, having a little meeting with you yourself and whoever is involved in the decision process is like, if you can be very clear about what your monthly budget is, then your mortgage advisor can help you stay on track. And they can say like, hey, don't go over X, or if the tax bill is Y, then this is what's going to happen to your monthly payment. And then you won't get into a situation where you fall in love with this crazy, beautiful home. And next thing you know, your budget is out the window and you're house poor.
That's a huge disconnect that can get you into trouble.
You touched on what is an ideal debt to income ratio. earlier, you can get approved, quote unquote, with like a 48% debt to income ratio most of the time, which means like, let's say that you're making $10,000 a month, you could spend $4,800 per month on a mortgage payment plus any minimum monthly payments on
Everything
cars
else.
or student loans or anything like that. It can also be very skewed if you have no debt, right? And all of a sudden, like, oh, you can afford $1 million home just because you have no debt, and we can get you approved to 48% debt to income ratio, right? So you need to have a budget. You need to know what's a comfortable monthly payment for you versus what the lender is going to approve you for. I mean, the lending guidelines are relatively conservative for most normal people that have $50,000 in student loan debt and $500 or $700 car payment. Once you budget all of that in to the 48% debt to income ratio, then you're like, oh yeah, all you can afford is a $2,500 mortgage payment. And that's probably what you should be spending, right? Like 25% of your gross. So budgeting is super, super helpful, whether you're a first-time home buyer or if you're going to be an investor.
So what else can we do to get financially prepared to buy our first properties?
Credit score, income is an important one. W-2 jobs are really, really good. The mortgage underwriting guidelines really like W-2 jobs. They're like considered like the safest. You just need to have a pay stub and a W-2 and you're good to go. So if you're going to be an investor, keep that W-2 job because it is going to get you into a lot of investment properties because you keep that W-2 job. So don't quit your job even if you have a couple investment properties. If you're self-employed, it's a little bit more challenging just because at that point we are looking at 2 years of tax returns. So it's also one of the things that you have to keep in mind if you're self-employed is that just because your gross receipts are $100,000 a year, that does not actually mean that that's what we're going to qualify you on. We're going to go not quite the adjusted gross income, but after all the deductions, and there's a few things we can add back in, business expenses, that kind of thing, pluses and minuses, and then we're going to come up with like, well, actually, we have $1,400 a month that we can use. So it's important if you are planning on buying a home and you're self-employed, one of the first things I would do is have a mortgage banker, mortgage underwriter, take a look at my tax returns and tell me you have exactly $3,489 per month to qualify, and then make your game plan versus living in La La Land where you think you're making $100,000 a year and you're going to be able to afford this $400,000 home, and then come to find out, like, hey, actually, you write off a lot. To get prepared, do a look back over the last 2 years of your tax returns with a mortgage banker, and then make your game plan if you're going to be buying in the next year or if you're going to be buying in the next 2 years. That way you'll know how to prepare your taxes, how much income you're going to need in order to be able to get qualified for a home in the next year or two. So, long story short, if you're self-employed, talk to a mortgage banker. If you have a W-2 job, keep it.
Very good advice. We've covered a lot. So for investors, have the Credit Suisse, like all these banks shutting down, has that reined in lending for investors?
The lending guidelines have been so conservative since 2008. For investors, we used to have 100% loans. We used to have interest-only loans. We used to have negative amortization arms. There was all kinds of shenanigans happening in 2005, 2006. With what happened in 2008, 2009, what are they going to say? You have to put 25% down instead of 20%. Income is fully documented. Assets are fully documented. Reserves are fully documented. Everything is fully documented. And it's a 30-year fixed loan. Like, where is it going to go?
True.
Your payment is going to be the same for 30 years. So it's pretty conservative. So I haven't seen it impact any of the guidelines. And that's one of the reasons I'm not too worried about a housing crash, just because I see how strict these underwriting guidelines are. And there's nothing funny going on here. The craziness that happened in 2008, it was very much correlated to the greed and the crazy mortgage products that were available.
That's reassuring for sure. Thank you so much for joining us today, Jasmine. We had a smooth ride. Ruth was on her best behavior driving because she knows she has extra precious cargo. Where can our listeners find you?
Instagram at Jasmine Mortgage Team, JasmineMortgageTeam.com, and TikTok, it's Jasmine Mortgage Queen.
We'll have links to where
All
we can
the things.
find the Mortgage Queen online.
Yeah, absolutely. I have my calendar up on my website. Perfect. So if you ever want to just hop on and schedule a mortgage consultation, you can grab a slot, and I'm glad to help anyone think through the next few steps. Thank you so much for having me,
Thank
Crystal.
you, Jasmine.
See you later, Jasmine.
What a great chat with Jasmine. Like, that was a lot of fun talking about money, 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 money.
Well,
the big thing that either, gets people in or shuts people out.
To me, the mortgage lender is your best friend in this because they're in the business to give you money, and you're going to need money to do this. And a lot of people try to hide things from their mortgage lender. And I'm like, no, be completely open, because if you're not, things can snag last minute and derail. But if you're an open book with someone who wants to make you successful as a real estate investor, they're going to find the strategies. They're going to give you advice like Jasmine's just done that will really make you grow your career. And personally, I've done over 20 deals with Jasmine, so I can specifically speak that she knows what she's doing when it comes to investing.
I like how she talked about what you get approved for and what you can actually afford, like what's in your budget. That's the difference in having like a real breathing live mortgage broker person rather than just, running off to the internet to see what's out there. Just go ahead and give that person a call, get that contact or referral.
If you guys want more information, go to stackingdeeds.net/show notes, and we'll send you everything that Jasmine was talking about, as well as everything we cover in today's show.
Is that a phone ringing? Why am I always surprised?
Yes, I hear the Rotary, which means it's the time for the last segment of our show. Ring Ruth's Rotary. You want to give it an answer?
Let's do it. Hello?
Hey, Crystal and Alan. This is Sean from Pennsylvania. On the first episode of Stacking Deeds, there was a comment made that indicated that too much cash flow from a property might be a bad thing. It was specifically stated that more cash flow results in more taxes being paid, but taking equity out of a property is free. Can you elaborate on an upcoming episode? What would be a good target amount of cash flow from a property? And what are the implications of doing a cash out refinance, pulling equity, and reinvesting it in another property? Thanks in advance.
Thanks for the question, Sean, and thanks for listening. So a lot of people debate, is it cash flow month to month or is it equity you're after? So, Alan, I defer to you.
Sure. I'll say that there's no wrong answer and there's no specific goal that you're trying to reach, Sean. Every investor is individual and everyone's situation is different. That being said, cash flow is great. Everyone wants as much cash flow as possible. And to me, the goal of real estate investing is not to have a paid off property. The way I approach this, Sean, is imagine we have a $100,000 paid off property. That $100,000, let's say it's rented for $1,000 a month. I would be making $1,000 a month in cash flow. That's assuming, there's no repairs and property taxes. It's very simplistic, but there's always going to be some sort of expenses. But let's say you're taking home $1,000. That is going to be taxed as if you're making income. It's a little bit better than W-2 income because it doesn't take out all the FICA taxes and the Medicaid and everything like that. So it is an improved income, but you can do it a little better by taking out a cash out refi. Let's say you get an $80,000 mortgage on that. So that means you have a $20,000 equity in it. Now you have $80,000 that you could distribute across other properties. You could buy 4 other $100,000 properties with that, put $20,000 down. So what you've just done is taken your one $100,000 property and you've turned it into 5 $100,000 properties, each with $20,000 equity, each with $80,000 mortgage. Collectively, if the numbers are all the same, you're probably still bringing home $1,000 a month. Why is that better? Well, to me, you're creating a mutual fund approach. So if you have one vacancy in a single family house, that's not going to make you any money. But if you have one vacancy in a portfolio of 5 homes, you'll still be making some cash flow. On top of that, let's say you think rents are going to go up $25 each year. Well, if you have one property, your rental income now is $1,025. If you've got 5 properties, your rental income now is $1,125. So you're making an extra $100 that way. If you happen to do a cash out refi and you put that money back into renovating your property through some sort of investment or improvement of the property, then the mortgage interest on that new mortgage can be deducted. And that's taken out of your cash flow. So you actually are not taxed as much because you have a mortgage interest deduction. That's what I was referring to specifically in that comment. Further, a lot of people are going to be listening and say, this is very risky to have 4 or 5 mortgages, Alan. You're crazy. And no, I keep coming back to we're creating a mutual fund of approach. And I'd rather have $20,000 in 5 different investments. If one goes south, that's fine. But if I have $100,000 in one investment and that goes south, well, that's going to hurt a little bit more. I have more cushion by spreading out my risk this way. So it actually reduces risk. And lastly, all the lawyers love saying this. If you have a $100,000 paid off property and someone hurts themselves, well, they can sue you for that $100,000 of equity. However, if you have a property that's got $20,000 of equity and an $80,000 mortgage and you get sued, they can only come after you for $20,000. So they probably won't sue you. So this is also another reason to try to take out all your equity and spread it around to reduce a lot of liability, increase your income, and really grow your portfolio. And I found expenses in managing it and vendors and everything goes down the more properties you have.
Got it. So in just a quick summary, these are 2 different scenarios. So one scenario, you have a $100,000 house, you're making $1,000 a month and you're getting taxed on that $1,000 a month. Now, you're not getting as taxed as much as if you were making $1,000 as a W-2 employee, but the cash out refinance, like tapping into your equity option, is to take that money, take the $80,000 to buy 4 more properties. And I guess a good balance would be, let's say you're making $200 a month on those properties each, which almost gets you to that same $1,000. But this way, since you have your cash out refinance, your interest is tax deductible. So that also reduces your tax liability. Is that true?
Yes. So the new mortgages on the 4 new properties are mortgage interest tax deductible. The one you just refinanced is not, unless you put that money back into that own property.
Yay. Thank you, Sean, for calling in. Do you have a question for Alan and I to answer? Ruth just handed me the phone number. It's stackingdeeds.net/voicemail. So leave us a message and we'll answer your question just like we did Sean's today.
What a great episode, Crystal. I learned so much from Jasmine, and your mortgage broker is going to be a great partner in this. So get out there and meet some folks that can really help you grow your career and also get to work and becoming a millionaire so that you can go buy a house in Hawaii. Who knew it was that expensive? But it is paradise, I suppose, Crystal.
I'm coming to visit you Hawaii peeps too. And I'm glad that Jasmine talked to us about finding someone that you trust, instead of just going online and letting the bots work all your numbers for you, when you have a breathing human. So that way you have someone that has your back. Like buying a house, that's a lot of money. So you want something that you can afford. You're not in over your head and you're not regretting your decision. So having someone walk you through all those scenarios, that's great peace of mind to have. Let's take it to Doug. What should we have learned today?
So what should we have learned today? First, take some advice from Jasmine Krnjetin. There are lots of loans out there. The key is to choose the right one for your project. Second, is your real estate empire just chilling? The BRRRR method might help you warm up your portfolio in a hurry. But the big lesson? All good real estate has a coffee maker. How come this trunk is big enough for me and a mic and recording equipment, but you gotta be kidding me, no coffee maker? Come on, guys, I'm falling asleep back here. Thanks to Jasmine Krnjetin for joining us today. You can find out more about her work at jasminemortgageteam.com. We'll also include links in our show notes at stackingdeeds.net. And don't forget to give our hosts a follow on social media. Crystal Hammond is at Condo Crystal and Alan Corey is at Real Estate Maxi.